Hello, I'm Tammy with your Week in Forex from UFXBank. Today we will take a look at last week's market highlights. Global equity markets closed out the last week of 2009 with moderate gains, capping an unbelievable year in which the Dow Jones Industrial Average gained 63.5% from its low back in early March. During that same span of time, the dollar-weighted index gave up 17%, before recently retracing roughly 4.5% of its loss. For a closer look at the markets, we're joined by foreign exchange analyst Martin Smith. Welcome, Martin.
Thanks, Tammy.
Last week appeared relatively volatile considering the light volumes. Is there anything in particular that stood out to you?
Well, the equity markets behaved as anticipated. However, bond and forex markets were more volatile than I'd expected.
Which move surprised you the most?
Looking at the US Treasury market, the yield on the 10-year continued to rise. As price moves inverse to yield, it suggests traders are going to be holding out for a rate hike. In the forex markets, I was surprised by Kiwi's strong move, having gained 2.5% for the week.
To what do you attribute the yen loss of 1.57%?
Well, that was also a surprising move, considering that most traders had already locked in P&L weeks ago. However, as the dollar carry trade has been unwinding and more traders are shifting the carry trade back to the yen, we also have the rumors that hit the markets about Japan Airlines filing for bankruptcy.
Oil seems to be making a silent yet steady charge in the market. What do you think about that?
Well, remember that the price of commodities are quoted in dollars. So as the dollar shows weakness, it will by default lift commodity prices. Oil's been holding firm at just $80 a barrel, and although most analysts believe the dollar will continue a soft rally, which would normally constrain oil prices, nevertheless, the market is also poised for pent-up demand to again accelerate the cost of a barrel.
For 2010, which key drivers in the market should investors monitor?
Well, there are quite a few. My approach is to use a barometer for the global economy, as well as vigilance with respect to economic data releases, particularly those that center around the consumer.
So what will you be watching closely at the start of this new year?
Central banks have stated that they will let many of the emergency quantitative easing programs expire in February and March of 2010. So we need to analyze the market's reaction once these programs are no longer in place. Will the spread, known as the cost financing, start to widen, since the government is no longer artificially creating liquidity in the market?
What about the economic releases that you mentioned earlier?
Well, the most watched will be, of course, unemployment. Obviously, people spend less when they are not earning. Beyond that, we have retail sales and manufacturing data. If manufacturing sees an uptick, then that implies an improved outlook for the jobs market. Also tells us consumers are in fact spending.
How will this impact the greenback?
Well, two things will move the greenback higher. First of all, panic, and second of all, real positive economic prints. On the flip side, anemic data releases, which I translate to mean really less negative. For example, if you have a negative GDP print one quarter followed by a slightly better GDP print the next quarter, but it's still negative, then that will be the type of news that will stymie the dollar rally.
Thank you, Martin, for joining us once again. Until next week, I'm Tammy, and be sure to visit us at UFXBank.com for simple, safe, and secure trading.